Which stocks stand out when it comes to return on investment? Coming up, today's guest will highlight 8 stocks of companies that do a great job of investing their money to benefit their investors. So let's get started. This is Ticker Take.
Okay, John, today we're going to talk about return on investment, ROI, with investor Kyle Taylor.
Yeah, Kyle thinks it's important when you're putting your money to work in a company that company shows they're good with investing their own capital. And this is important right now, Caroline, because everybody's investing in AI. As a company, as a business. And actually, MIT did some work last year that found that a huge number of early investments by companies into AI has not paid off. So smart companies, when it comes to allocating capital, that's what he's looking for.
All right. With all that said, let's hear more context from Kyle.
The portfolios that I manage, they're typically a combination of both public and private investments that we put up against a disciplined process for investing that accepts the simple facts that what worked yesterday or last year may not be what works tomorrow or for the year ahead. And really, that's why we lean towards being more style agnostic. And today, that means positioning our portfolios in a way that should benefit from rotation away from the priciest areas of the market. And I think that's really important in an environment like today, given so much headline concentration in the indices and the implied risks of investing with the crowd at a time when there should be a premium in being highly selective with the businesses we invest.
Okay, coming up, Kyle is going to walk us through 8 stocks of high ROI businesses. But first, he explains how he goes about selecting those stocks. Let's hear from Kyle.
I think self-help stories are really interesting because they're companies that are working to improve their margins internally while also seeking opportunities for top-line revenue growth. And I really think you have to look at the quality names that are doing interesting things to better their business, which, yes, sometimes involves the use of AI. But to us, we're looking for sustainable competitive positions in good and growing industries. We're looking for a management team with an excellent track record of value creation. And we're looking for a balance sheet that is strong enough to weather almost any adversity that they may face in the upcoming future.
All right. With all that said, let's get to Kyle's 8 stocks now. But first, a friendly reminder. This is not financial advice. Stock number 1, RBC Bearings.
Company here that is focused on aerospace and defense. Let's hear more from Kyle.
RBC is really interesting. They make highly specialized products and parts that are used in things like Boeing airplanes and nuclear submarines. And they have a really great CEO who's been a part of the business since 1990. His name is Michael Harnett. And he actually has a doctorate in applied mechanics. And he's compounded growth for shareholders at almost 20% annualized over the last 20 years. And really, they've sought some really great acquisitions that have been accretive to the business, enhanced their product lineup. And what I really like about this business in terms of being an example of a self-help story is the fact that management is actively seeking ideas from all levels of the business. They have 25 divisions within their business, and every month in divisional meetings, they are looking for 4 to 5 business ideas on how they can improve operational or financial performance within their division. And I think that's something that's very interesting. And a lot of those ideas often get used and are an example of how they can improve margins within the business. You add on the fact that they're in an industry that is very sought after. In terms of defense spending, there's that mantra going on in the US. 90% of the revenues, in fact, come from the US. Boeing and Airbus are 2 of their biggest customers. They've given them really good pricing moving forward as they ramp up production. And thirdly, they have a backlog that reflects a lot of this. Last year, their backlog was $825 million. This year, it's $2 billion. So again, going back to the defense spending and a lot of the margin growth that they've seen internally, they're in a really good spot to add a lot of value for shareholders and within the business.
Stock number 2, Deere & Co.
A company that has come up a lot on Ticker Take. Let's get Kyle's perspective.
I think a lot of people know John Deere as the manufacturer and distributor of ag equipment for farmers and the like. What's really interesting about them is, and this was said to me years ago, that Tesla is not a car company, it's a data company. And I think Deere is a good example of just that. In fact, they spend over $2 billion of annual R&D, more than twice their nearest competitor. They have data on over 500 million acres in the markets that they operate, and all in an effort to drive insights so they can help increase the per acre profitability of the partners, the farmers that they work with. This is certainly a business that is not going out of style. Anytime people need to eat, and until that changes, this will continue to be a great company. You layer in the fact that AI can be a meaningful driver to help turn some of this data into actual practical applications for their business and for farmers to help grow that profitability. I think that's really promising. And why I like them today in particular is we're coming off of tariffs that were hurting the farming sector, particularly in the US, quite hard. So the combination of the cyclical recovery as well as the AI applications can be really useful for this company. And I think that they have one of the widest moats of any company around.
Stock number 3, Roblox.
Another name we've talked about before on Ticker Take. Let's find out why it's a standout for Kyle.
Roblox, I think, would be known for anybody who has a Gen Z kid in the household. 40% of their users are under the age of 18. 80% of their users are under the age of 25. You could really describe Roblox as the YouTube for gaming, in which that there are creators and consumers of the content on this platform. And what I really like about this company is that management's made some really great decisions, and they really proved the naysayers wrong coming out of COVID, as the platform retained and grew daily active users. It was actually in the third quarter of 2025, they were reporting that they had 150 million daily active users on their platform. And they've compounded growth since COVID at 34% annualized. And I mentioned management's been making some really great decisions internally. Number one, they have been really intentionally slow about rolling out ads on their platform to make sure that it doesn't conflict with the brand. Not only that's something that's changing in 2026. That'll open a new vein of profitability for Roblox. They've increased player and content moderation at a time when many other social media platforms are pulling back on that, which I think is really important from a reputational side, given their users are primarily Gen Z. They're primarily under the age of 18 and 25. And 3, they can use AI to incorporate into game development on their platform and actually shorten lead times for the creators who are designing these games and add some interesting tools to make it more user friendly. And I think that's something that can really help drive the stock. And it's something that is really a credit to the management team of Roblox. And another final catalyst that I would say for 2026 is the fact that they pay pretty sizable processing fees for things like Apple's App Store and Google's App Store. They're increasingly moving a lot of those transactions onto their own platform, as they could really credibly be described as having the world's largest metaverse. And I think they have their own currency that reflects that.
Stock number 4, Extendicare.
We've talked increasingly about the trend towards aging populations. Here's Kyle.
So Extendicare is a well-known Canadian provider of care and services for seniors. They operate roughly 100 long-term care homes and also deliver home health care services for seniors across the country. I think senior living is being a pretty favored area of real estate. So it's got a lot of attention given the fact that the demographic trends aren't slowing down. Extendicare really has an excellent track record of making very accretive acquisitions. And what the most recent was CVI Home Health, which they acquired from Omers in late 2025. And I think this is an example of an acquisition that was a good one for the business. It helps diversify their home health segment away from just the province of Ontario and help diversify the business line in that sense. You factor in also the integration of and the potential applications for AI in healthcare and health services. That's something that can help enhance patient and resident experiences simply through better care. And again, I think that the bottom line for them is that the strong demand for senior living will continue, and they're in a really great spot from a balance sheet perspective in order to make acquisitions and act very opportunistically.
Stock number 5, Exchange Income Corp.
This was an investment that was in one of our earlier videos about top names for 2026. Let's get the perspective now from Kyle.
So Exchange Income they're in the business of acquiring companies with strong cash flows, particularly in rather niche markets. And they've got a very a great track record of compounding returns for shareholders. They've annualized over 20% returns since 2004. And they primarily focus on aerospace, aviation services, and manufacturing. They're actually the leading air transport provider in northern Canada, which is actually deemed a essential service from the federal government perspective, which helps reduce the cyclicality that other airlines may face. On top of that, they also service Eastern Canada and Atlantic Canada. You look at I think they're in a really interesting spot today because you look at the emphasis that's being placed on Arctic defense and infrastructure. They're in a really great position to capitalize on that, but none of that was by accident. They've been making this decision to operate in underdeveloped markets that can be very accretive for them from a profitability perspective. They have a very conservative balance sheet today and modest leverage that should allow them to continue to act very opportunistically as those opportunities arise to add value and add businesses to their core business that can be very accretive.
Stock number 6, Rogers Sugar.
A pretty sweet play, as the name would suggest. What makes it a standout on ROI? Here's Kyle.
Rogers, they distributes sugar and maple syrup, granulated sugar, and the company sells its under various brands. It's called Atlantic in Eastern Canada, Rogers in Western Canada, and they sell their maple syrup to over 50 countries. I think as Canadians, we maybe take for granted how great our maple syrup is, and the fact that that's a growing segment for them and reflects a lot of global demand. They've made a lot of decisions in the past several years to invest in the business and grow, and they're starting to see the benefit of those initiatives in the form of increased profitability and greater economies of scale throughout their supply chains. And I think that's something that investors will continue to look for. They have several projects that continue to be on the go. Of course, people will continue to look for the cost budgeting and how they're on track with their targets in that perspective. But for investors today, even at current prices, you're still getting about a 6% dividend. So you're being paid for your patience to wait as those new capital projects can continue to come online and increase capacity. And I think they're in a really great market to continue to grow the business.
Stock number 7, Cameco.
Well, we have talked a lot about the nuclear boom, but let's get some more context on this one from Kyle.
I think Cameco's had a lot that's gone right for it on the macro sides. But really, what I've liked to see from management in particular is that they've adopted the show me the money mentality rather than aggressively ramping up production without locked in contracts. And that's something that reflects really well on the management team and the decisions that they're making. And I think can also serve them well if the AI theme and demand stumbles a bit in the near term, because they haven't gone over their skis too much in terms of investments. But the fact remains that uranium has one of the greatest structural deficits of any commodity out there today. There's a looming deficit in 2035, which is projected to be in the face of increasing demand over the upcoming decades. And, Canada is the number 2 producer of uranium behind Kazakhstan. Kazakhstan's had a lot of supply issues. There's sanctions on Russia, and uranium will continue to be needed as people make the transition to cleaner energy and also, as you said, to data center power to help that theme, not just in North America, but also in Europe and Asia.
And stock number 8, Pan American Silver.
Well, a lot of people have seen that record run up for the metal, but beyond the performance of that, what is it that makes this company stand out? To Kyle, here he is again.
I mean, they have operations in Canada, Latin America, South America. They've been in operation for over 30 years, and they've made some really great operational decisions, help grow margins, as well as some acquisitions over the years that have helped grow value for shareholders. I think you can look at them more from the perspective of as a go-to name for silver, but because everyone knows about the precious metals rally. But I think as we enter this next phase of real assets and precious metals, we will enter this consolidation phase. And I think Pan American is in a really good spot in terms of available liquidity to capitalize on those opportunities. You factor in the increased free cash flow, the undrawn credit that they have available to them. They have about $2 billion in available liquidity disposable for them to help invest in further operations and better the mines that they're a part of, and maybe even acquire some smaller players to help grow their footprints. And I think what's different about silver in particular than some of the other metals, particularly gold, is the industrial uses. Silver is often mined as a byproduct of other metals, which means that supply can be slow to catch up. I was surprised to learn that 2/3 of silver production, it stems from those industrial uses, from solar panels to electronics. And roughly 20% of the global output annually just goes to solar panels. So there will continue to be these industrial uses, which I think will offer a lot of support. But in terms of silver or any of the other metals, the increased retail activity will probably drive some additional volatility. So I think we're looking at that quite opportunistically moving forward.
Thanks for watching here on the BNN Bloomberg YouTube channel. TickerTake has its own YouTube channel. You can find a link in the description.
See you next time.